If you understand 20 stock market words, you can understand 90% of what investors say. In the next few minutes, I'll give you the only terms beginners actually need, organized, so they finally stick. Quick disclaimer, this video is for educational purposes only. This is not financial advice. I'll teach the only terms you need in 3 buckets: trading, company basics, and risk. And near the end, the one tiny term that costs beginners the most. Bucket 1, how prices and trades work. First, stock. A stock is a tiny piece of ownership in a company. It matters because when the company does well over time, owners can benefit. Example, if the business grows, more people may want ownership, which can push the stock price up. Common mistake, treating a stock like a lottery ticket instead of ownership in a real business. Next, share. A share is 1 unit of that ownership. It matters because when you buy a stock, you're really buying shares. Example, if you own 10 shares, you own 10 small slices of the same company. Common mistake, thinking share is totally different than stock. One is the thing, one is the unit. Next, price. The price is simply what the most recent buyer and seller agreed on. It matters because it can change every second based on demand. Example, if the last trade happened at $50 per share, you'll see $50 as the current price. Common mistake, assuming price equals value. Price is today's number. Value is what you think it's worth. So what actually makes price move? 2 words, bid and ask. The bid is the highest price buyers offer. The ask is the lowest price sellers accept. It matters because trades happen between those two. Example, bid $49.90, ask $50. Buyers and sellers are negotiating in real time. Common mistake, thinking you always buy at the displayed price. You usually buy at the ask and sell at the bid. The difference between bid and ask is the spread. The spread is the gap between the bid and the ask. It matters because it's a cost you feel when you buy and sell, especially if you trade often. Example, bid $49.90 and ask $50 is a 10-cent spread. Buy then, immediately sell, and you're down about 10 cents per share before the market even moves. Common mistake, ignoring spreads on less popular investments where spreads can be bigger. Now, order types. This is where beginners get surprised. A market order means buy or sell now at the best available price. It matters because it prioritizes speed over a specific price. Example, you click buy and it fills instantly at the current ask or slightly higher if price is moving fast. Common mistake, using market orders during fast moves and being shocked by the fill price. A limit order means only buy or sell at this price or better. It matters because it gives you price control. Example, you set buy at $50 or less. If the stock never hits $50, you don't buy. Common mistake, setting your limit too strict, never getting filled, and then thinking the market blocked you. Mini summary for bucket 1. If you understand bid, ask, spread, and market versus limit orders, you already understand what most beginners don't. Now, 2 words that tell you how smooth trading is: liquidity and volatility. Liquidity is how easy it is to buy or sell without moving the price much. It matters because higher liquidity usually means tighter spreads and fewer surprises. Example, a popular ETF often has lots of buyers and sellers, so trades feel smoothly. Common mistake, buying something illiquid and later struggling to sell at a fair price. Volatility is how much the price swings up and down. It matters because volatility affects your emotions more than your math, especially early on. Example, something that moves 5% in a day is more volatile than something that moves 0.5%. Common mistake, thinking volatility automatically means bad. Volatility is normal. Your time horizon decides whether it's a problem. Bucket 2, company basics, what you're buying and how the business is doing. First, market cap. Market cap is the company's total value in the stock market. It matters because it's the quickest way to compare company size. Example, market cap is roughly share price times number of shares. So a $10 stock can be bigger than a $500 stock. Common mistake, thinking a lower share price means a company is cheaper. Next, index and ETF. An index tracks a group of stocks. It matters because it's how people talk about the market. An ETF is a basket you can buy and sell like a stock. It matters because one ETF can give you broad exposure without picking individual companies. Example, an ETF can hold hundreds of stocks. Common mistake, assuming all ETFs are safe. Some are broad, some are narrow and risky depending on what they hold. Now, diversification. Diversification means spreading your money across many investments so one bad outcome doesn't ruin everything. It matters because it reduces the damage of being wrong about any single company. Example, if one stock drops, but you own a wide basket, the impact is smaller. Common mistake, thinking diversification means buying random stocks. Real diversification avoids heavy concentration in one thing. Now the business words you'll see everywhere. Revenue is the total money a company brings in from sales. It matters because it shows how big the business activity is. Example, if a company sells $1 million of products, that's $1 million in revenue. Common mistake, thinking revenue equals profit. Revenue is before expenses. Earnings are what's left after expenses, profit or net income. It matters because earnings are what a business can reinvest, save, or potentially return to shareholders. Example, $1 million revenue with $900,000 expenses means $100,000 earnings. Common mistake, hearing record revenue and assuming that automatically means the company is doing great. Profit margin is the percentage of revenue that becomes profit. It matters because margins show efficiency, how well a company turns sales into earnings. Example, $10 profit on $100 revenue is a 10% margin. Common mistake, focusing only on revenue growth and ignoring whether the company keeps any profit. Dividend is a payment some companies give shareholders, usually from profits. It matters because dividends can be one part of total return alongside price changes. Example, if a company pays $1 per share per year and you own 10 shares, you receive $10 over the year. Common mistake, thinking dividends are free money. They come from the business and don't remove risk. Now, the famous one, P/E ratio. P/E is price to earnings, stock price compared to earnings per share. It matters because it's a quick way people discuss how expensive a stock is relative to its profits. Example, if a company earns $5 per share and the stock is $100, the PE is 20. Common mistake, assuming low PE always means cheap and high PE always means bad. Context matters. Mini summary for bucket 2. Market cap tells size, indexes and ETFs explain the market. Diversification reduces single company risk, and revenue, earnings, margins, dividends, and PE help you interpret business performance. Now, bucket 3, risk and your plan. This is the part that prevents beginner mistakes. Risk and return. Risk is the chance outcomes differ from what you expect, especially on the downside. Return is what you gain over time. It matters because higher potential returns usually come with more uncertainty. Example, big swings can bring big gains, but they test patience. Common mistake, chasing return without asking, can I hold this when it drops? Time horizon is how long you plan to keep your money invested before you need it. It matters because time can reduce the impact of short-term volatility. Example, money you need next month has a different risk tolerance than money you won't touch for 10 years. Common mistake, investing money you might need soon, then being forced to sell during a bad time. Dollar cost averaging means investing a fixed amount on a regular schedule. It matters because it removes the pressure of perfect timing and builds consistency. Example, investing $100 each week means you buy more shares when prices are lower and fewer when prices are higher. Common mistake, thinking it guarantees profit. It doesn't. It helps consistency. Now, 2 mood words and 2 drop words. Fast. A bull market is when prices generally rise. A bear market is when prices generally fall. A correction is a notable pullback. A crash is a sudden, sharp drop. These matter because names influence emotions, and emotions drive bad decisions. Common mistake, treating every drop like a crash. Now, the tiny term that quietly costs beginners the most, fees. Fees are what you pay to own or trade investments, and they compound against you year after year. The common one in funds is the expense ratio, the annual fee a fund charges as a percentage. Example, 0.50% versus 0.05% looks small, but over many years, it can become meaningful. Common mistake, choosing a fund because it sounds good without checking the expense ratio. Let's lock this in with a recap. Here's your next step. Grab paper and write the 3 buckets across the top. Then write the terms under each bucket, exactly like we did. That one-page glossary turns future investing videos from confusing into obvious. And if this made the stock market feel clearer, like and subscribe for more.